Hey YouTube, it's Nick here. Welcome back to the channel. So a lot has actually went on this week. Companies are hitting all-time highs. They're beating their earnings report, and we kind of capped off the week with the jobs report. Now, as far as what we're going to cover in this video, we will talk about the jobs report. We're also going to talk about AI. I personally think something kind of big is going to be happening later next week, and then we're going to cap it all off with why the stocks are hitting all-time highs. Is there much more opportunity? And we'll close it off with what I'm doing in the market. Now, first things first, jobs. We lost 23,000 jobs. Okay. Now, I'm not gonna sit here and go through all of this now. I got the nitty gritty of what went down, and this is what happened. So basically, the the entire U.S. it lost about 23,000 jobs. Now, as far as what is going on as far as the unemployment rate. Now, this is the one that's actually pretty jarring a little bit. So the employment rate dropped down to 4.1%. But here's the thing. Over 260,000 people gave up. Now, that is the big kicker in all of this. Now, when it comes to unemployment, if you don't know, we're not going to make this a whole video about it, but basically when you stop looking for a job, you're not even counted in the statistic for unemployment. So the unemployment rate is not it's technically it's not 4.1%. It's a lot higher than that. Now, when you look at the report, a lot of things got dropped and it was basically jobs where like I honestly still haven't found a better way to say this, but a lot of jobs that got dropped were basically jobs where it not that it's not needed, but you're not like doing much necessarily. And a lot of that has to come down to we're obviously getting better workflows and things like hospitality, managers and like retail stores, all of that. Basically, a lot of these companies are trimming their fat, and you're like if you even work in some of these places, like you might be actually like running like a skeleton ship. Now, some of the jobs that were added, this is what they didn't necessarily say, but a lot of the jobs that were added in all of this was basically healthcare. You had your construction, things of that nature. And again, I said this in another video, and I'll say it again. I think the main thing with all of this is that there are a lot of jobs out there. It's just a lot of people either don't want to work them or they're not qualified for them because almost a couple like thousands of jobs were added to construction. You got someone that probably was making $2,500, maybe just being like a I don't know, you could probably be doing real estate, you could probably be a banker or something like that, or a lot of government jobs were cut too. So a lot of jobs where people were kind of like sitting in, air conditioning and stuff like that. Those are kind of the jobs that are getting cut. Plain simple. Now, if you have someone that's, let's say, making $25 an hour, they have AC and stuff like that, they're probably not going to take that 17, 18 an hour construction job. One, they're probably going to have a different commute. It's physical, so it's going to be taxing on the body. Now, that's just the construction side of it. Now, if you look at, let's say, healthcare, all like over 55,000 jobs were added to healthcare. Now, when it comes to something like that, there's a lot of people in healthcare that aren't able to fill positions. But at the same time, even though there's positions open, you have a lot of people that aren't qualified for it. So there's a lot of things that are going on in the market now. Why all of this matters is basically it's a judgment of whether we're going to get interest rate cuts. Now, interest rate cuts that basically determines how much you're going to pay on your credit card bill and interest, what your car loan is going to be, things of that nature. So it does make a difference as far as your everyday life, and because these numbers kind of shape how the economy is moving. Now, at the same time, these companies are making all this money. So a lot of the things that people have mentioned about the market is that even though people are, apparently aren't finding jobs or things like that, there's still a lot of people that are spending money, and they're basically saying that consumers have been very resilient, even not only with just, not having jobs, but even when it comes to oil prices, which has kind of went down a little bit. But all of that all of that it's really weird when you start looking at it, because that's my main conclusion for all of this. And I think a lot of people like even myself, I'm not excluded from this, so it plays a part in my life too. But the main thing is that A lot of people have lost jobs. 200,000 plus people gave up. They're just like, we're not doing it no more. Like, but I think that there's so many jobs out there. It's just a lot of people just don't want to work them. And the jobs that people might want to work, they're not qualified for either. Now, how do you fix this? I do not know. I wish I knew. If I knew, I would be making a lot of money if I knew how to fix all of this for everyone. Now, as we look at the markets a little bit in the portfolio, everything has been good this week. Again, like I said, all these companies have hit their, like most of them have hit their earnings. They've reached new all-time highs, some of them, and it's looking good. So if you have been in some of these companies, you're doing pretty well. Now, compared to my last video, the portfolio is looking a little bit different. We added some new things. The main thing that I'm kind of excited about is the Robinhood Ventures. So I bought one share again. We're not a hedge fund manager. We're not making hundreds of thousands of dollars. So we got to build up these positions little by little. Now, 25 to $50, that's kind of my max for each of the positions that I have. And then I'll hopefully grow them over time to around, anywhere from 1 to possibly 5% of my portfolio, depending on exactly what it is. Next, AI. Now, I thought that this was actually pretty interesting. Now, Claude Code auto mode becomes default as agents gain native OS control. Now, Anthropic is making Claude Code's autonomous mode the default for Pro, Max, and team users starting on August 14th. Now, the whole point about this is that they're going to be able to have agents work on iPhones now. Now, this take follow me with this. Now, basically, the way AI has kind of been right now is that you have to type in your prompt and then you kind of have to go step by step with it. We're not to that point where it can just do all the work for us. Now, a lot of people would love that. I think a lot of people would, but we're not at that point. But with them being able to give it like access to iPhones and things like that, let's say you want to build an app on your phone, you could write in your prompt to Claude. It can test like the app, build it on your iPhone, fix any bugs, and you don't really have to do anything. And here's my thing with all of this is that you had the dot-com boom, right? You had Bitcoin when it first started. You had social media, right? AI is the next thing. So there's a lot of opportunities out there, and I think the main thing is that you're not going to be able to do things the way you've always been able to do it in the past. You have to adapt with times. That's another reason why I don't even think the jobs report is necessarily that bad either, because I think the market is forcing the average person to not be average, and it's kind of disheartening in a way because some people, like I said in plenty of other videos, some people just want to have like a regular normal life. They don't want to always be looking to go to the next step or go to the next level or anything like that. Some people just want to live regular lives, relax with friends, family, and just be comfortable. But I think we're at a point now where that like the only people that are comfortable are the people that are already racking in money. But don't let AI be the thing that kind of holds you back from doing all that. This is that one time where if you can learn how to use these tools and not only be able to like make something better for someone else, you could even just make something for yourself. And I think that'll be the next wave as far as the people that are going to do well in all this. Because let's be honest, like here, I had it up here on my Copilot. I use Copilot to kind of look at what's trending like on the internet. And when I go back to what I was just looking at, basically these jobs, you had about 25,000 to 55,000, depending on the source, in healthcare. That's been the strongest one. And that makes sense. The baby boomers are going out. They're going to need someone to take care of them. We're making a lot of advancements in science. So there's just a lot of people that maybe have disabilities, mental illness, and you just need more people in these areas to take care of these people. And on top of that, you might even have people that just have regular everyday things. The point is that there's not enough people to take care of all the people that come into these hospitals. Construction, we already talked about that. There's so many jobs in construction. All these data centers, who you think are building it? And then you have manufacturing. So that could just be things that, you'd be working in a warehouse or something like that, stuff like that. Now, As far as the jobs that were lost, you just had the government, you had retail, you had leisure and hospitality, and you had financial activities. So that's just more so like your what's gonna call it? Like your bankers, your tellers, what else? Like I can't even think of all of them right now. Like I had it up here on my list, but okay, here we go. Banking, insurance, real estate, mortgage, financial services, related office jobs. So a lot of office jobs got cut, but the main one was government, surprisingly. So that could be like education, public sectors, administrative workers, and then the other one was leisure and hospitality. So a lot of restaurant workers, cooks, servers, bartenders, hotel workers, housekeeping, entertainment, recreation. A lot of those like that in the government got the biggest cuts out of all of this. Now, I'm not gonna say restaurant workers aren't doing a lot because again, a lot of these businesses, when it comes down at the end of the day, it's all about bottom line and profit. So if they can trim, like if you have 10 employees and you can trim about four of them and still make about the same amount of money, they're gonna go that route. They don't care. So my thing is to stop. Well, and this is me too. This is me too included. We gotta stop looking for others to kind of help us live our life. Like we gotta figure something out. And my thing is that I believe AI in some shape, form, or fashion, that's gonna be the thing that kind of gets people, out of the bubble, I guess you can say they're in. No pun intended. Like same thing with social media, same thing with Bitcoin, people that were early investors into it. It's those that find things before it's completely blew up. Like we keep talking about it now because it's the future, but it's already here. And the thing is that you like the things that some of these models can do, like we should be paying hundreds of dollars to be able to use it. But you can get access to some of this stuff for just $10 a month, $20 a month. I'm just saying. So don't neglect AI. Don't neglect it. Now, another thing we're gonna be going over is stocks. So, like I said in the beginning, everything has just been hitting all-time highs. Everything's been going up. And a lot of people are now wondering how much higher can it go? A lot of people that are just getting into investing or trying to and keep at it, they're trying to figure out, wow, all these things kind of ran up. Where's the opportunity now? Everything's expensive, right? So we're gonna have three videos that we're gonna cover and basically kind of go over that. So the first one's gonna be stocks extend record highs, the investment committee strategy. So we're gonna see what these investment strategists and what they kind of think about it, and I'm gonna give my thoughts on it too as they start talking. So let's go.
There's a fair amount of bullish commentary that I want to lead our show off with today, not just from our very own Josh Brown yesterday on Halftime, who said this was one of the healthiest tapes that we've ever had. Wolf Research today, is the next stop 8,000? Ed Yardeni yesterday on Closing Bell with me, 8,250. He said that might look too conservative, thanks to strong earnings. And here's Goldman's president John Waldron with Andrew Ross Sorkin today in Aspen, pretty positive as well.
I would say the most important factor right now is earnings growth. Earnings growth continues to be really strong. We're going to have the second quarter was the seventh consecutive quarter in the S&P of double-digit earnings growth. So we've had very consistent and significant earnings growth, which is propelling markets. That's ultimately the most important fundamental driver. And I would say recently it's broadening.
Okay, so it's strong, it's broadening, and until that changes, you want to get negative?
No, I don't think you want to get negative at all. I think you want to understand where capital is flowing to and then understand what the potential risk is accordingly. We've seen in the last several days a return of the momentum factor in particular, isolating memory, semiconductor, and even the Mag 7 itself. Really strong day today from NVIDIA kind of coming out of nowhere. So where is the risk in all of that? Over the last several days, you are seeing the S&P market cap weighted outperform the S&P equal weight by 4%. So I would believe the risk as you move through the entirety of the summer is you lose the broadening narrative if the market, Scott, gets concentrated again. You do not want a concentrated market. That's a marketplace where portfolio managers like myself will underperform. It's a very challenging marketplace, and it pushes all the chips in a very isolated direction. That's the risk in the market.
Yeah, I mean, but what's the realistic risk? Because if you listen to Waldron and others, if the earnings story itself is broadening, and it's strong outside of tech,
yeah,
there's not an indication that your biggest risk is going to happen.
So no. So you're always sitting there saying to yourself, what can go wrong?
I hear you.
So I'm sitting here today, my strategy, Josie ETF, all-time high. I'm sitting here saying to myself, okay, what can possibly go wrong? Where does that begin to reverse itself?
What if we're though entering a market where you need to start thinking about what else can go right? In terms of if you're getting broadening earnings, Jimmy's shaking his head, he's smiling. If you're getting broadening earnings growth like Waldron's talking about and others are obviously focused on to why stocks can continue to go up from here, Maybe that's the more apropos question today.
Well, and I feel like you and I had this conversation maybe 2 weeks ago. Remember the other 493 versus Mag 7s on earnings growth? And as we look in the second half, we're going to see that other 493 companies, their earnings growth probably surpass that of the Mag 7. But you're seeing it in the stock price reaction. I mean, let's consider things like Delta Airlines or the airlines in general. I'm just kind of pulling that out of thin air. But when you have a good economy, when you have broadening profit growth, a company like Delta is going to be approaching new highs as it is right now. And not just new highs, but a re-rating of the multiple. Or, Joe, as you and I spoke about yesterday, financials. If we weren't having this tear the cover off the ball rally in semis, we'd be talking about the rally in financials.
Well, we're going to be talking about that because they have made a nice move, and there's some kind of stealthy moves that have happened within the private equity prism. I'll get to all that in a minute. I do have some news that I do want to get to. Mackenzie Sagalis, it's regarding Alphabet. What is that?
So, Scott, we're seeing Google shares down around 3.5% now. The company reshuffling the leadership of DeepMind as Demis Hassabis moves into a new chairman role that's going to be focused on frontier research and then the broader implications of AGI. Hassabis will remain active, but with more time now devoted to AI safety and policy, scientific research, and medicine, including a bigger role at Isomorphic Labs. That's the drug discovery side of the company that he launched after DeepMind's AlphaFold breakthrough. Now, also as part of this reorg, you have Koray Kavukoglu, who will take over day-to-day leadership as the new head of Google DeepMind. He has already been running much of the lab's model research since becoming Google's chief AI architect last year. So the company is framing this as a natural.
I'm just gonna cut her off right there. Google. Here's the thing: with all these Max 7 companies, you have like your Google, your Amazon, your Microsoft. Like these are the people that have already proven that they can survive markets, and they continue to innovate. And when you look at something like Google, like it's not just the Google search engine. You have YouTube, you have their AI. There's so many avenues that they're pulling in from. It's not even just one thing. So none of this low key, like none of this matters. So I'm actually gonna skip this because it really doesn't matter. Like I believe in Google being in my portfolio. I will continue to build into it. That's without a doubt, and I already get exposure to it through the S&P 500 and the Nasdaq as well too. So none of that matters to me. I believe in Google, and I believe that these, like, you have your Amazon and them, your Google, your Microsoft, like those are the people that are going to be here 10 years from now. Those are the companies that if you do want to at least put some cash in, not financial advice, but if that's a company you want to invest in, no one's going to tell you that you're doing something wrong by doing that. So we're going to skip that, and then we're going to actually look at my boy Tom Lee because I think this is much better. Let's hop right into it.
This make or break hour begins with the call of the bulls, who say stocks are going much higher from here. And we've got one of them on our program today, Fundstrat's Tom Lee. He'll be here with us in just a moment. And he's far from the only one who thinks 8,000. CNBC contributor, Fundstrat's Tom Lee, Solis's Dan Greenhouse. We're all here at Post 9, as you can clearly see. Tom, it's good to have you. I'll start with you first. You say we could go 7,900 to 8,000 this month alone. So this momentum's going to continue.
Yeah, I think the deleveraging that happened a couple of weeks ago put a lot of cash on the sidelines, got sentiment quite bearish, and then on top of people getting very skeptical of the Fed, got markets to de-risk. And now I think as earnings have been good, and I think there's a rethink of how inflation might be cooler than expected, and of course AI is still strong, there's going to be a chase. I think that chase takes us towards 7,900, 8,000.
Most people who are putting out bullish notes cite both of the facts that you did. This major deleveraging process, which was a reset for the market. There was no real fundamental change in anything. It was just there was some froth that needed to be worked out. There was some leverage that got a little bit too high, and all of that needed to be worked out. And then the backbone of the whole thing, the earnings. John Waldron of Goldman was talking about that just yesterday morning.
Yeah, that's exactly right. I mean, earnings this quarter is coming in more than $15 ahead of what people expected at the start of the quarter. But what's really more impressive is 2027 earnings are up now $8. So we're probably close to $4.10 for 2027 earnings. And we're only 3 weeks into earnings season. I actually think it might settle out closer to $4.25 by the time earnings season's over.
Sound reasonable to you? And it's not just Tom, obviously. It's, I've been hearing more 8,000 calls sort of, day by day with Ed Yardeni saying his 8,250 could be conservative for the very reason that Tom just suggested. Earnings are just really good.
Yeah, I mean, as we're seeing on the screen, the S&P is already at 7,700, so 8,000, no disrespect. I mean, it's not a huge lift percentage-wise.
I think the implication, though, is like that's just the next stop in this train.
Yeah, I mean, because the thing with the earnings is even if you X out technology and you subtract, say, 10 percentage points off the gross number, earnings are still good. And when you listen to it, as many of us do, any number of companies in any number of industries. The
Almost all of them.
Yeah, the AI story is going well, from Eaton and 3M and those adjacent companies. You look at the charts of the KRE, the BKX, the financials are at highs, the KIE, the insurance companies are at highs. The commentary across the board from the card companies, who I mention every quarter, about consumer spending just fine. So you have all the investment themes going on, AI, power generation, et cetera, et cetera. The consumer's doing fine. Jobless claims 2 weeks in a row, sub 200. For viewers out there who are not aware, under 200,000 in jobless claims didn't happen one time from 2000 through basically through COVID. These are exceedingly incredible numbers. And so just when you take a step back from one being bull.
Hold on. I'm gonna stop him there. Like I said earlier in the video, like I don't think that's a good thing because you right now you can look up on YouTube or anything like that and you can see hundreds of videos. There's like it's like a new trend. The talking head in a car video talking about how you can't find work. You put in like 200 applications and and you're not getting work. So again, like even those people, those 200,000 people that reported just giving up, one, they're not included in the unemployment for one. So that 4.1%, it doesn't include them. If you stop looking for work, you're not considered unemployed, which that doesn't even make any sense. But it did on top of that, you can't even trust it because that's just the 2000 that like they're not tracking everybody. There's so many people out there without work. Now, again, I think that there are a lot of jobs out there, but like I said, there's a lot of people that either don't want to work the jobs that are available or they're not qualified for them. Those are literally the two options. And then on top of that, you have a lot of people that are exceedingly qualified. They're trying to get whatever they can. Because here's the thing, a lot of people, when it comes to work, most people want to be able to make money with the least amount of stress as possible, right? The least amount of stress as possible. So you're going to have somebody that's probably overqualified, 10, 20 plus years of experience. And now, because this is the big thing, a lot of people are competing with younger people in the market too. So, and then there's like this weird economy where people think younger people don't want to work or they don't know how to basically operate in what's the word, like how to operate in a in a work environment. Like so you not only have that, but then you have older people, and then there's ageism with stuff like that. A lot of people feel like older people can't be taught new things, or they kind of come in with a habit, so they're not as moldable as well too. So there's a lot going on, and there's a lot of competition in the market too, because no one wants the exceedingly hard jobs. Either that or they're not qualified to do them in the first place. So that's the main thing. A lot of people, like I don't know, everyone's saying the economy is doing good. That's debatable. That is debatable. But you gotta keep in mind, when they sit up here, they're not thinking about the average person. They're only thinking about themselves and the people in their bubble. So they're not gonna understand what someone, not even hell, not even me. Like I'm doing okay, but like they're not gonna understand what someone like me has to deal with. And there's a lot of people in situations worse off than me as well too. Like there's a big boom. There's people that are 30 living with their parents because they can't even make ends meet. So I think a lot of like they while they sit here and say like the economy is doing well, like there's a lot of people that are kind of just making it by, and a lot of people aren't able to actually live the lives that they truly want to live as well too. Like yeah, you could probably be making 40K a year, but like let's say you're in California, you might have to live with your parents still, right? So like, or 50K, 60K, you still might have to live with your family depending on where you're at. So it like, yeah, the economy's doing well, but like the life I live is not the one I want. Like this, like I'm kind of barely making it by. I'm not able to start a family. I'm not able to date. Like there's so many other things that kind of go into it that they don't think about. So when they say the economy's doing well, you gotta take that with a grain of salt. Now it on the screen, yeah, it is doing well. All these stocks are hitting all-time highs. So like the businesses are doing well, but I would say the average person probably not as much. Just throwing that out there. I'm done.
Bullish or bearish. The backdrop is positive. Now, the valuation argument is something we can have. You look at SanDisk and some of the moves in those names, obviously South Korea, but the fundamental backdrop is still very positive.
And there are always going to be idiosyncratic valuation issues within any bull market. But one of the overwhelming, I think, characteristics of this particular bull market is the ability of this stock market to correct itself, to rid itself of excesses that feel uncomfortable at the time, but don't upend the story. We witnessed that a week or so ago. We had the largest crash in momentum than we probably, and the fastest one that we probably have ever had. And then if you pile on top of that a blow up in a hedge fund that's heavily levered to the AI trade, and yet the market was up 3 or 4 days consecutively following that, and we find ourselves, closing at record highs, and today obviously notwithstanding.
Yeah, there's a market structure conversation to have in here about the way the market acts and performs these days. But I think your point's exactly right. I would have been and was one of those people who would have told you 6 months, a year ago, whatever. Well, if the Mag 7 or SanDisk and AMD drop 20, 30, 40%, the broader market's going to be down at least 5 to 7%, if not 10 to 15%. And that didn't happen. The rest of the market, for lack of a better word, picked up the slack. I find that in advance of it shocking. In retrospect, very thankful, because you have the market at a high. 4 sectors are outperforming. A fifth is basically in line. Half the index is doing better than the index. You can't really do too much better than that. It's pretty good.
Some are wondering whether people are too giddy. I mean, the nuance in your bullishness, it has been and it remains to be that you still think we're going to have a sizable correction in the market before we have a pickup. I was going to ask you before I read the notes that you gave our producers whether you thought that already happened. Yeah. And in fact, you don't think it happened already.
No, I don't. I think we've had a rolling bear market in a lot of groups, Mag 7 and software, crypto, and now the AI stocks. But we haven't had a broad de-risking. I think that is later this year, and it probably is around this inflation derangement syndrome that is the market is very concerned about, whether the Fed should be hiking in September. I think there's a real battle until September. But our take, of course, is that inflation is much weaker. I think that there won't be a hike in September.
Well, I mean, if the market comes around to that view, then why would you have a 10% pullback? You think the market's just going to get so crazy with itself that it's going to convince itself that there's a hike coming in September? Even, by the way, amid reports in some publications that Chair Warsh is ready to do that if he has to, if inflation remains hot into that meeting.
Yeah, I think it's still hotly debated because there are economists who want the Fed to hike just to reestablish credibility with financial markets. We know the media and investors are impatient with inflation because it's at 2.6. They want it down to 2. But at the end of the day, if underlying inflation is much weaker, which is our take, then I think it's a mistake for the Fed to hike. But this is not a consensus view. I think it's still a battleground.
How about that nuance of Tom's outlook? The fact that, everything's great. You pointed out so many of the reasons why so many are now bullish. But this is lurking. Yeah. And it's going to be, Jackson Hole later this month. Then this Fed meeting in September, which is going to be one of the real wild cards in this whole story.
So with respect to the Warsh statement about, well, if inflation keeps going up, then that's the most banal down the middle statement a Fed chair can make. If inflation is exceedingly high relative to our target, then we're going to have to hike rates. So I'm fine with that statement. Generally speaking, I'm with Tom. I don't think inflation is quite as bad as the headline numbers suggest for a whole number of reasons that we're not going to get into now. I disagree that they shouldn't. I think the 50-50 is right. We have a jobs report, we have some inflation readings, and those reports are going to carry even more significance than normal in terms of what the Fed.
What are you saying, 50-50 that they'll hike?
Yeah, I think the market is priced about 50-50. I think it should be 50-50. I think I could make the case that they should. I should make the case that they can.
Just keep in mind, at the September meeting, it won't be 50-50. It's binary. So that's why it's a battleground September meeting. In the sense that if they don't hike, then the market might even fight that and trigger volatility.
I will tell you, I mean, I would push back on that, I guess, in the sense that it could still be 50-50 because for the first time in a long time, we're not going to get the hand-holding from the Fed that so many have become used to, which is why no matter what happened in the prior meeting, it could be deemed a surprise relative to what the market was already, had convinced itself was even possible. So things are a little bit different as that goes.
I think it sort of ties into our view that the market's still in the process of testing the new Fed, Kevin Warsh, because he is trying to rethink communications, forward guidance, and even what inflation is.
Is that why the 30-year is sticking at 521, 520? There it is, 521 today.
Yeah, because it may be reflecting the uncertainty that is created by lack of forward guidance and lack of Fed comms. Or it could be the idea that it's inflationary. We actually don't really know what's being priced into the market.
And if I can pivot off that for a second on the credibility conversation, there's a number of, I disagree that the Fed is losing credibility. I don't buy that argument. I'm not alone. I know Torsten Slok recently put out something along those lines. Robin Brooks, formerly of Goldman Sachs on Twitter, made a similar argument. We're not alone. There's a transition going on here. It's sort of, the analogy I've been using is akin to letting your child cry it out when they're younger and have to go to sleep. The child is used to you coming in every day and patting you on the head and putting you to bed. And now all of a sudden, daddy doesn't show up and the baby's screaming. And to some degree, the market is the screaming baby. I don't know that this is totally correct, but we'll go with it. The market is the screaming baby right now, figuring out what is the new normal in this era. And I think 50-50 in that type of environment where the Fed is not holding your hand, for better or worse, is the correct probabilistic outcome in front of a jobs report and a couple of inflation
reports.
My
point is the market's, so what you guys were just alluding to as well, the market's not used to going into meetings 50-50.
Sure.
It usually knows.
Well, it should probably get used to it. It should probably get used to it because according to the article today, it's here to stay. And again, that's his prerogative. We can debate whether that's the correct course or the incorrect course. Obviously, any number of people have come on air and argued it's the
social media
course.
too. I mean, there's obviously a huge debate about that, but the mechanisms of that are certainly different to what the conversation relative to what the markets are going to do between now and then is going to be. The broadening story. if earnings are broadening so much, like Waldron was talking about yesterday morning, then theoretically the market should continue to broaden as well, right?
Correct. If you exclude the second quarter earnings are up 50% year over year. Excluding investment gains, it's still up 22%. That's a huge step up in organic growth for the S&P 500, which was running at 13% last year, and it is broad-based. And I think the good news is that some of these are being reported at a time when there were energy inflation pressures and tariff headwinds. So I actually think the repeatability is the good story, because next year those anniversary.
Last point.
Four sectors are up more than the index. A fifth is basically tied. Mid caps at a high, small caps at a high, the UK at a high, Germany and France at a high, Brazil and Mexico almost at highs. There's lots of evidence that this is not just some Fed or AI-infused rally specifically in the United States. There's lots of things going well. And again, getting back to the original point to tie it up, every company in every industry is basically saying we're good.
All right, more conversations to come. We know that, guys. Thanks. Appreciate you being here too.
So just to touch on that a little bit. So I mean, he is right. Everything is looking good for the companies and the businesses. Now, when we look at the fear and greed index, we're sitting at about 64. So this is greed. So what this means is that we're getting a little euphoric. All right. You got the VIX, it's sitting at 14.9. Now, personally, anything that's kind of sitting right there, I'm a little cautious on adding any money. Now, personally, I added most of what I have here before it even hit that. Kind of did it earlier in this week around Monday, Tuesday, and Wednesday or so, and I just kind of added to some small things. So like AMD when it dropped down a little bit, like I said, I added the Robinhood Ventures Fund. Long story short, it has OpenAI in it. Regardless of what anyone says, I actually think um it's going to do well. So I want to get some exposure to that. Now I can make a video about that later, but I don't think it's that important. And I added a few more too. So and we're looking good. But my thing is what I'm gonna keep doing. One, when it comes to crypto, we're sitting at 31, so we're in fear. So all the liquidity is in AI and tech mostly. So that's where most of the liquidity is now. And Bitcoin is doing well. It's sitting around like 64. So it's not too hot, but if you have seen my other video about that, basically we're adding to that through USDC rewards and cashback on my Coinbase debit card. So we kind of stopped doing that for a bit. But as far as the stock market, we're sitting at greed, and we're getting close to extreme greed as well too. So my thing is, I believe Tom is right. I do think that we actually will reach a newer all-time high, but we're still going to get a pushback. Now, it'd be different if it was a 20% drop in stocks right now. But imagine if let's say the S&P is like at 8,500 or something like that, or then that 20% drop can come. So that's what's going to bring us towards the closing of this video almost, is because now everything's kind of just bumped on up. So now it's like, okay, where are the opportunities? Are there any opportunities left? Should you sit on the sideline? And this is more for my retail investors, because I'm just like you. Like, I built my portfolio with $1 to $5 a day. I didn't come in, I didn't just drop 5,000, I didn't just drop 1,000. I said, okay, I'm gonna start and build my BTC position, because that's my high conviction asset, and then I'm gonna build my stock side. And then if we look at it, VU's about 12%, QQQM is about 6%, and then SCHD is about 4%. So we're we're trying to overweight the portfolio, but I consider VU, QQQM, and SCHD all the base of the stock. So I kind of join all those percentages together. Now, is there any opportunity out there? I'm not going to be the one to tell you that. That's what our last video is going to be about. And we're going to see exactly what these strategists have to say. So he says investors are missing opportunities, and there's a lot more out there. This video was uploaded 3 days ago, but we're going to touch it now. So let's see.
Right now, joining me now with $4 trillion in assets under management is Goldman Sachs Asset Management Chief Investment Strategist at Innovator, Tim Urbanowitz. Tim, it's great to have you here.
Great to be with you, Cheryl.
Well, the tech onslaught continues. What did you make in particular of SpaceX and all this concern about CapEx spending across the board?
Well, Cheryl, I think it's very clear the market is done rewarding spending, and they want to see free cash flow. And we think this is going to continue to be a pretty big story and source of volatility really for the rest of the year. If you look at the big four, they've guided CapEx up to about $725 billion. And right now we're seeing basically a record gap between where these names are trading from a price to earnings standpoint and a price free cash flow. So we need to see free cash flow. I think that's what the market is concerned about. And right now, from an investment perspective, we're talking to advisors about how do you diversify away from that AI trade, adding in sectors like financials, healthcare, consumer stocks that have had negative correlation to the AI momentum trade all year long.
Well, how do you do that then? You ask the question and answer it.
Yeah, and I think that's a big piece of it is looking at those sectors that have diversified to those other sectors.
Yeah,
we're also seeing,
is it financials?
I think those are a big piece of it, but also one of the biggest trends that we're seeing right now in the advisor and ETF market is a shift toward options-based strategies, things like defined outcome ETFs that are providing built-in risk management and really helping remove a lot of that uncertainty around free cash flow and the tech issue.
Yeah, because we've seen, that rotation we've talked about so much. We've seen that going into healthcare. We've seen some of that going into the financials, which, by the way, that sector had very strong numbers. Goldman Sachs, your company, one of those companies, but that did well and impressed the street. So do you reward them, pull some money out of AI? That certainly seems to be what is happening. But you say one of the things, this is one of the biggest mistakes you're seeing today. Many advisors have positioned portfolios for only one type of market shock, a growth scare. Why is that a mistake in your opinion?
Well, if you look at the issues that investors are facing today, we don't put that at the top of the list. The top of the list right now is inflation. Inflation that's stemming from this AI spending cycle, inflation that's stemming from this war in Iran. It's not necessarily growth. And if you look at the 60-40 portfolio, which so many advisors that we work with rely heavily on, it's very heavily dependent on long duration fixed income, which does really well when growth pulls back. But in inflationary environments, that's not always the case. So again, adding in those strategies that we know are going to work with built-in risk management options, there's no guesswork, is really important. And then also, Cheryl, I think diversifying within that equity sleeve. And again, so much of the market is driven by AI momentum. How do we diversify away from that? That's really important as well.
Yeah, look, whether the economy, higher energy prices. I mean, right now we're seeing a big pullback in oil. One headline out of the Middle East changes that. We're up another $10, $15. Again, I hope that doesn't happen, but obviously we're seeing a reprieve right now with the Middle East situation. But in general, you do see a lot of these portfolios, I'm assuming, that are just too overly weighted. I'm assuming that's into AI. There's got to be more out there for investors, especially with Caterpillar's numbers.
It is. There's a lot more out there. We want to diversify. You look at the equal weighted S&P 500 index, been doing very, very well. But Cheryl, one of the things that we want to watch, I mean, we really view the rally we're in right now as an earnings driven rally, which is exactly what you want to see. We saw valuations contract in the front half of the year. But when we're looking at a lot of these AI names, most of the growth, in fact, you strip out AI names from the S&P 500, you're looking at earnings growth that's about half of what it is without it. And again, that all stems down from the hyperscaler spending. So the hyperscaler spending is not just about CapEx, it's about what trickles down as well.
Real quick before you go, Tim, how much do you factor in any Fed moves?
Well, I think the Fed is really important, and I think you have to prepare for higher interest rate volatility at this point. The communication style of the Fed, at this point, we don't even necessarily have a framework, Cheryl, for how investors need to think about what the Fed's next move is going to be. And investors love certainty. They don't like the unknowns, and we think that leads to more interest rate volatility. At the end of the day, though, we think that it's all about buying time while not losing credibility for Kevin Warsh.
Well, I think the bond market has a lot more say than the rest of us right now and what happens with the interest rates, what the Fed does. Tim, it's great to have you on the program.
Great to be with you, Cheryl.
Okay, that was great. So what I'm doing is I'm continuing to dollar cost average into my low cost index funds. Now, as I mentioned in another video, I stopped QQQM because I just wanted to get one share. That way I have my exposure to AI and tech like that. And there's a lot of companies that I personally believe in and that either I use or that I've done a little bit of research on. And I'm like, okay, I'm actually comfortable allocating some some capital into it. And now all of these, I know these are tiny positions. Some of them are like $1, $2, $5. You're right. Obviously, the ones that I have the most conviction in, which if we look at like AMD or anything like that, then like those are the ones that I'm actually, like actually focused on allocating, more of my funds into. Celsius, I bought a share of that when it was falling down. I from what I've seen, and I've actually drink Celsius too. So like I was a big fan of that, especially during like 2021, 2022. You're seeing a lot more of those on the shelves. Now not gonna dive too much into it, but the main thing is that I'm continuing to build my base of the S&P 500 and SCHD. So that's the one that I still haven't stopped, and that's kind of how I see my way of diversifying a little bit, so that way I can kind of shave off some of that volatility, and then we kind of stop allocating the Bitcoin for this month through just new capital as well too. So that way, because at some point something is going to happen. Another thing I've noticed is that gold has started to go up too. So I was really hoping that we would get below 4,000 again. We haven't. So I'm still figuring out how I'm going to allocate to that because the fear and greed's at 64. So I think we're gonna keep going. Honestly, I think we're gonna keep going higher for a long time. This isn't gonna stop until the business cycle ends, and then and we'll probably enter a recession when that happens. Because statistically, that's usually when business cycles end, is when there is a recession. So I have noticed that like a lot of people, like gold kind of went up a little bit. So I think some people are kind of pricing that in and they're preparing for what's to come too. But I'm gonna keep doing my $5 a day into VOO. If we do get that pullback, which they're talking about is going to be around September or so, a little bit later in the year, then I'm gonna bump that back up. I'm gonna actually bump that up to $10 a day, and then we're gonna and then honestly, I think I might just start buying like just a share of SCHD a week or at least every 2 weeks. I think I can make that happen because the whole goal of this month is to build up cash and then just let it earn a yield. Like that's the main thing. But I really wanted to focus on stocks this month because I feel like that's where it's at right now in the market, and there's still opportunities in crypto as well too. But if you have seen any of my videos, especially anything with me talking about crypto, you know that I believe that Bitcoin is the only thing that matters. Everything else it's just a farce. Everything is piggybacking on what Bitcoin does in the future too. And you have your people that can mention XRP or Ethereum or Solana, but if most of them bleed to Bitcoin anyway, why not just hold Bitcoin? That's my thing. So that's what I'm doing in the market. I think we're gonna end it here. You see the portfolios approaching 5K, so we will have a video coming out for that soon. I'm just gonna wait for it to kind of get to like 5,000, like 50 or 5,100 or so before I do it. But it's looking pretty nice, especially from where we started off at. So if you take anything away from this video, give it a like, especially if you probably didn't learn nothing new. But if you're thinking about investing and you want to get started, you can do this for just $1 a day on Robinhood. I'll leave a link to it in the description. You get a free stock. You don't even have to put your own money in, and you get a free stock. It could be $5 to $200. Something's better than nothing. But the main thing with all of this is that your money's losing purchasing power every day. You gotta have it working for you in the background. And if you don't know anything, just pick a low cost index fund that tracks the S&P 500 or something that just tracks the entire world stock market. Whatever you feel is comfortable for you. And if you did make it to this point in the video and you do want maybe some more information about that, you just gotta let me know in the comments. Now I know we're starting this channel off from the ground up, so it probably won't even reach this point of the video. But if you did, I appreciate you for sticking this out. That's what's kind of going on, and then I'm gonna knock out some more videos so that way we can get the ball rolling on this channel. I have a lot of ideas, but we just have to get there one step at a time. So like the video if you did, subscribe if you're new, and I'll check you out on the next one. Have a good day. Bye.